Hello, my name is Patrick Yanke, certified financial planner practitioner with Yankee Financial here in Raleigh, North Carolina. Securities offered through Raymond James Financial Services. Welcome to this quarter's Capital Markets Review. As always, my purpose is to inform and to answer questions on the economy and the financial markets. This isn't meant to be my prediction for the course of the stock market for the remainder of this year and beyond. Rather, it's a review of economic and historical data to help investors make informed decisions about their financial futures. Once again this quarter, I have chosen to use slides from the Guide to the Markets produced by JP Morgan Asset Management for the simple way they present complex ideas. Most slides have multiple charts on them. I'll point out the information I think is most relevant. JP Morgan is not affiliated with Raymond James. This quarter, there are four main themes I want to discuss. Let's start with recession risks are rising. First quarter GDP growth was greater than 3% annualized over the same period of the prior year. The second quarter showed a slowdown to 2.4% year over year. Economists are forecasting more slowing down to around 2% per year growth. The risk of recession is growing, however, consumer spending remains strong. The slowdown is anticipated in the business investment and inventory areas of the economy. These areas are greatly affected by uncertainty, and the cloud hanging over international trade, largely due to tariff talk, may be a major factor here. Businesses may have front-loaded their inventory needs to get ahead of import tariffs. Both areas are strongly mean reverting. This means that higher than average numbers in prior quarters may be met with lower numbers in subsequent quarters. The strength we have seen over the last year is the reason economists are forecasting a drag on GDP for the remainder of this year. Inflation remains fairly tame by historical standards. It has held steady so far this year. One reason for subdued inflation is that below average wage growth continues. Even with historically low unemployment, employers still have pricing power in this economy. An interesting note about business investment and the market cycle, see the left chart here. Based on the headlines, you would expect that businesses lay off a large number of workers when anticipating a recession, but that isn't the case. They tend to freeze hiring when they anticipate recession. The layoffs come after the recession has already begun, and to a much lower magnitude than the hiring freeze. As the recession ends, layoffs are curtailed and hiring resumes. In this market cycle so far, hiring remains strong. The dollar was expected to weaken this year, but it has done the opposite. This means your overseas investments are having another bad year. More on that in a moment. Note the U.S. trade balance and interest rate differentials on the right. Both are improving to the advantage of the U.S. Both are good signs for our economy. The price of oil can be a drag on our economy when it rises significantly. Recently, OPEC and Russia agreed to not increase oil output to keep up with global demand. As you can see in this upper left chart, they have lost some of their influence when trying to increase the price of oil. American production has been largely responsible for global production keeping pace with consumption. In fact, economists are forecasting a surplus of oil production for the foreseeable future. A price of oil above $50 a barrel allows American shale oil producers to produce oil for a profit, not so much below $50 a barrel. American producers are helping to keep the price of oil in check globally. What's interesting about this chart is that the price of oil remains fairly tame even after the attack on Saudi Arabia's oil production. Despite fewer active rigs this quarter and lower inventories, the price of oil is still lower than last quarter. Looking at global manufacturing, we can see that there is quite a bit more orange and red on this chart than previous quarters. What's interesting is that the weakest areas are those that depend on exports, likely hurting from the tariff discussion. Take a look at Germany, Taiwan, Mexico, and Russia. The weaker areas of the previous chart are the ones on this chart with exports as a significant share of GDP. At only 8% of GDP, the U.S. is actually somewhat insulated from this situation and in the best bargaining position for adjusting barriers to trade with our trading partners. A thought on trading. Rather than trying to run with the short-term volatility of the markets, investors may be well served to look beyond the current trade talks to the future and invest based on a long-term view. Those hurting the most by the current discussions may be the ones who benefit the most from the eventual resolution. As the trade talks continue, there has been a slowdown in global GDP growth. Most of the weakness has been overseas. U.S. earnings growth remains strong. As of the end of September, the S&P 500 is up over 20%. If that were the number for the whole year, it would be a very good year in the market. One message investors should take from this, though, is that the remainder of the year could be a bit tougher. Overseas investments have also done well in their local environments. However, U.S. investors are realizing less than local investors as the strengthening dollar has removed some of the reward when returning to our home currency. When markets are low, all it takes is the courage to invest. When markets mature, it's important to rely on experience and in knowledge. Let's talk about interest rates. The recent movement of interest rates has been down. Currently, investors in the 10-year Treasury are realizing a negative yield relative to inflation. At these levels, fixed income is better used in a portfolio as a hedge against equity volatility than as an actual income vehicle. Stretching for yield can prove to be problematic for investors. The greater the yield in this environment, the greater correlation to equities. In other words, those who invest in bonds as a hedge to equity volatility may experience equity level volatility in their bonds by reaching for too much yield in this environment. The current expectation is for more rate cuts by the Fed. The disconnect on this chart may be explained by the survey of Fed governors. There are 17 members who forecast interest rates. Among these, the average is for rates to hold steady and then rise again. However, of the 17, only 10 actually vote on rates. Among those who actually vote, there is greater dovishness, with an average anticipated rate cut of about 0.5% by the end of the year. So far, market expectations for Fed rates have been correct. One of our long-term risks is government debt. Currently, paying interest is about 8% of the federal budget, borrowing about 22 cents for every dollar spent. As more debt is accumulated and interest rates rise, the cost to carry the debt will increase. Although it's manageable now, sooner or later the government must show some financial responsibility. The dangers are considered to be far in the future still, but it is a long-term danger. Notice in the bottom right that federal debts are expected to increase their rate of growth, and that's not a good trend. See the bottom left chart for CBO expectations for the economy. For this year, the CBO expects GDP to grow by about 2.7%. Going forward, they see growth rates slowing back to sub 2% levels. It's important to note that this isn't an anticipation of recession, it's simply an expectation for the rate of growth to decrease. Quantitative easing has returned. The Fed and other central bankers around the world had been on a program of reducing their balance sheets. That has now given way to more asset purchases. As long as the federal government needs buyers for the debt it issues, the Fed will remain the buyer of last resort. This means they will continue buying as long as there aren't enough market participants for the full issue. Let's talk about the equity markets. Between March 9th, 2009 and the end of September of 2019, the S&P 500 increased by 340%, excluding dividends. Those with a short-term view of history could be forgiven for seeing a market peak at these levels. Consider, though, that what we have been through is what's known as a secular bear market. More on that in a minute. There are really two phases when evaluating PE ratios. The secular bear, where PE ratios are contracting, and the secular bull, where PE ratios are expanding. The only way you know you've gone from one to the other is in hindsight. Through the recent secular bear, forward PE ratios contracted from 27.2 times earnings to their current level of 16.8, which is, by the way, up from 16.7 last quarter. The yield on the S&P 500 is still above the 10-year Treasury. This chart shows secular bulls and bears over history. The secular bear markets are noted by the horizontal lines. It is normal that the markets move to new highs after lows in the PE ratio. It is fairly cyclical. The average secular bear is 14 years long, and the most recent started in March of 2000. Is it over? Only time will answer that question. However, strong market performance shouldn't deter stock investors with a broader view of history. We seem to have broken out of the recent bands of market performance, but that doesn't guarantee a future without significant volatility. Equity valuations depend on both price of stock and the earnings of the companies underlying the indices. The PE ratio remains near its long-term averages. In order for the markets to move forward without increasing the PE ratio, equity prices must keep pace with earnings. The forecast for earnings is to increase by about 5 to 7% per year for the remainder of this year and next. Higher equity values suggest this is an environment for strong equity and sector selection. I favor sectors with lower than average PE ratios. Financials and healthcare are two strong sectors for the long term. Domestic investors will find greater value overseas. It may take patience, but there is a lot of room for growth outside of our borders. What should investors do? Well, it takes courage to invest. Even though the market finished positively 75% of the years in the last 39, the average year saw an intra-year decline of just under 14%. Those who would invest in equities should focus on their financial goals and not react emotionally to every market move. Complacency may become a significant factor, as investors haven't experienced historical market volatility for a while. When the markets become volatile, it can be stressful, and investors who only recently began investing may react emotionally. Note that even when the market doesn't finish positively, it never finishes on its low. Selling into a panic isn't a good strategy for wealth preservation nor long-term growth. The dip we saw last year of 20% ended at a loss of only 6%. Those who were hurt the worst were those who panicked and sold for the loss. We would all love to be able to invest without risk. If I offered someone an investment which would have an average annual return greater than 7%, most people would jump at it. That's the red line. What that line represents, though, is the average annual return of the S&P 500 for the 20 years ended with the bottom of the fiscal crisis or the end of February 2009. As painful as the market felt in the dot-com bust of 2000 to 2002 and the fiscal crisis of 2008 to 2009, the returns for the long-term investor were still fairly robust, even at the worst of it. By the way, why do you invest rather than taking a guaranteed 7% over the long term? This chart shows what happened since the bottom of the S&P 500 to now. Guaranteed returns look good in the worst of times. Over the long term, they create more financial opportunity loss in a portfolio than the short-term volatility of the markets. In this mathematical example, it would take a loss of greater than 50% in the S&P 500 to return to the 7% average line. Last year is just a small blip at the end. It's important to note here, though, that the S&P 500 is an unmanaged index. It's not possible to invest directly in the S&P 500 index. Past performance is no guarantee of future results, and some successful money managers have seen even better results. Consider your asset mix. I like to show this chart to demonstrate volatility. Those asset classes which rise the most also fall the most. Another lesson is not to chase returns. What led in growth one year is not guaranteed to lead the next year. In fact, oftentimes the leaders move to the bottom of the class. Maintaining a diversified portfolio has generally worked for the long term. What's on top doesn't stay there, and what's on the bottom will move up again eventually. Volatile asset classes will usually be found at one of the extremes. Asset allocation can help make growth a smoother ride for investors. There's another story here. Up until 2008, a diversified portfolio beat the S&P 500 5 out of 7 years. Since then, the diversified portfolio has underperformed the S&P 500 in every year. This can cause investors to put aside diversification in favor of unmanaged indices. Despite recent experience, diversification is still important. The low volatility of recent markets was an ideal environment for unmanaged indices. If we return to normal volatility, we may return to the normal situation where managed money beats unmanaged money 2/3 of the time. Also, current strength in the market may make it tempting to park some gains in cash. Although there are periods when cash is king, over the long term, cash is always found near the bottom of returns. Investors with a long-term view should invest in long-term assets. While diversification and asset allocation help mitigate risk in a portfolio, they don't guarantee against loss. The 20-year annualized returns of available asset classes are shown in the bottom chart. It would be logical to assume that a well-diversified investor would find their own return to be somewhere in the middle of these asset classes, as their returns reflect an average between them. That isn't what we see, though. We find that the average investor has a much lower average return. In fact, at 1.9%, the average investor hasn't kept pace with inflation over the last 20 years. If they had simply held any one of these other asset classes through the good and bad times, they would have been better off than trying to time the markets. Research shows that working with experienced financial advisors can help investors be consistent, even when it's difficult, and that has helped investment results. I am always happy to review and answer questions. The disclosure charts can be a bit of an eye chart and hard to absorb in this setting. My presentation is on my website, where you can see it more conveniently. Thank you for watching. If you have any questions, please feel free to reach out to me. My contact information is on this slide. See you next quarter.